Good morning, everyone. Welcome to today's webinar. I'm Linsin, your consumer and healthcare analyst. So for today, we will be presenting on company initiation, which we have published last week on Old Chang Kee. And next, we will be providing you an update on company results released last week on China Aviation Oil, DBS, iFAST, and SIA EC. So without further ado, let's move on. Old Chang Kee. So as the title said, puffing up capacity and margins. These are the sub-brands. Some of you might not have heard of some of the brands. Nevertheless, let's continue. To give you a brief snapshot on how Old Chang Kee was performing, its previous close was at 72 cents, and our target price is at 98 cents with a buy rating. We forecasted a forward dividend at to FY17 at 3 cents, so this implied a forward dividend yield of 4.2%. Old Chang Kee. So we have a buy call, and these are the summary of our investment thesis. So the most important key takeaway that you must remember is that the completion of the factory redevelopment, which is targeted to complete by first quarter of fiscal year 18. So their financial year end in March. So first quarter FY18 would imply June 2017, next year, mid of next year. So why is it this the most important point? So for the new factory, they are going to provide additional product lines with better margins. So this will drive its bottom line. And we expect the bottom line to grow at 8.9% CAGR over the next 3 years. So this will imply that at FY19, the PATMI should be able to jump 29% as compared to their last release full year earnings at FY16. And the other key investment points will be their inorganic and organic growth through new stores and higher same-store sales. Improved free cash flow profile after their capex on the new factory in June next year should be able to provide a higher payout for dividends starting from FY19. And the other one will be on their competitive advantage, which are difficult for competitors to replicate. So without further ado, let's go into detail of each of these points. I believe that all of you are familiar with this local brand, Old Chang Kee. So if you are not, this is a picture of their signature product, their Old Chang Kee Curry Puff. Currently, it has more than 30 food products, which include their famous chicken wings, their gyoza on sticks, their chicken nuggets, and so on. They also offers breakfast items like your nasi lemak, mihun goreng. So these products, wide range of food products, are sold at a price of $1 to $2. And as mentioned earlier, they also own other subsidiary brands such as Take 5, Curry Times, Bun Times, Mushroom Cafe, and Dip and Go. So Old Chang Kee was listed on HX Catalyst board in 2008 January with a new share price at 20 cents per share. From this chart itself, you can see that their same-store sales growth have actually been stagnating at about 1 to 2%. Why is it so? It's because that the lack of innovation of new products. You can see that in 2014, 2015, they only introduced 2 new puffs product or 2 new flavors. But in 2016, we can see that they have introduced way better, way more products as well as flavors of their puffs. But some of it are in the later part of calendar year of 2016, which would spill over to their 2017 financial year. So some of it we have yet to see their impact. But from here you can see that there's already an increasing same-store sales growth. So why are they slow in innovation? It's because due to lack of resources. They only have one factory facility. Their original factory facility was situated in 2 Woodlands Terrace. So to address this resources constraint problem, management has acquired 2 factory facilities back in 2011 and 12. One in Iskandar, Malaysia, and the other one is at 4 Woodlands Terrace. We call this the new factory. So as you can see from the address itself, it's actually just adjacent to its original factory facility. So for these 2 factory facilities, they have already completed their construction works and have since commenced operations. But we have yet to see their impact because they only completed at end of FY16. So for FY17, we should be able to see a better same-store sales growth. So with the completion of the 2 construction projects for their new factory facilities, now Old Chang Kee is reconstructing its original factory facility in the 2 Woodlands Terrace. They are installing a better and more advanced technology machineries in their new factory as well as this original factory facility. So with the reconstruction, they are planning to integrate both factory facilities in Woodlands Terrace. So we call this as the new integrated factory facility. So with this integrated factory, is expected to be completed in June 2017, which is their first quarter of FY18. It's expected to increase their capacity by 60%. So from the current 50,000 puffs per day, they will increase the production capacity to 80,000 puffs per day. So the integrated factory facility will provide you additional production space, which is almost double, to provide the additional capacity for their product innovation, to conduct more R&D. So with this, we expect higher same-store sales growth, and we're also expecting margins improvement. So this is a picture of their current factory facility in Woodlands Terrace. This is the new one that they have completed in FY16. This would be the original one which they are reconstructing at the moment. So as we mentioned just now, that they are going to boost their same-store sales growth by introducing more new flavors of puff as well as new products and ready meals. So for new flavors of puff, for example, they have recently pushed out this rendang o. Why is puff new flavors of puff so important to Old Chang Kee? Because puff is actually their core product. It accounts for more than 30% of its total sales. So management has shared that historically, when they push out any new flavor of puffs, is expecting to boost sales volume by 3 to 10% higher. And they are currently introducing more new products. For example, the popcorn squids, ready meals such as signature curry chicken and the sambal fish cutlet rice. These products have higher price points. So as compared to their $1 to $2 price range, these are actually priced at a higher price points, which could increase their per ticket average, hence a higher same-store sales growth. Hence translating to a higher same-store sales growth. As these are actually leveraging at the same central kitchen, which are producing curry chicken, their chili paste, rice as well, with the same cost and a higher selling price, they're actually fetching a higher margins. So with this, we should be able to expect that both top line and the bottom line should go together with the new product offerings. With that, we are expecting earnings to grow at 8.9% CAGR over the next 3 years. Having said that they are going to grow their product lines, so what about the demand? According to the latest household expenditure survey by the Ministry of Trade and Industry, so it was surveyed for the 10 years period between 2002 to 2012. You can see that from this chart alone that food has been the second largest component of household expenditure, and the average food expenditure has grown faster than the pace of average monthly household expenditure growth. You can see that here with here 3.5% per annum and a 4.6% per annum as compared to a 3.5% per annum for 10-year CAGR. And from this chart alone, you can see that we split it for food expenditure to food and non-alcoholic beverage and food services. So for this, it's actually the raw food materials or any fresh products or groceries. As for food serving services, it would consist of restaurants, cafes, fast food kiosks, and so on. So for this chart itself, you can see that food serving services have outpaced the growth for food and non-alcoholic beverages expenditure. So this chart is telling you that there are rising tendency of Singaporeans to dine out, and there are rising demand for takeaway and convenience foods. So with Old Chang Kee offering a wide range of affordable food goods and the bite-sized ready foods, we think that this strategy itself fit well into the busy lifestyle of Singapore. And the growing demand actually bodes well with Old Chang Kee's expand strategy. So having said that there's growing supply, growing demand, so how is Old Chang Kee going to capture all this growing demand? So they are actually going to increase their store count to reach out to more consumers. Currently, they have 77 retail outlets island-wide, as you can refer to this map. Management said that although currently with these 77 retail outlets, they have yet to reach market saturation. They do not have a targeted store count, but Old Chang Kee sales is actually driven by consumers' impulsive buying. So the more convenient the location is, it will provide more access points to capture this impulsive buying. And if investors are actually concerned about if there's any cannibalization with the increased store counts, management has actually shared one of their example where there are two adjacent Old Chang Kee retail outlets in the same area. So you can see that from the Choa Chu Kang MRT station, which was initially a Pai Kia outlet, then they have converted into an Old Chang Kee outlet. There's another one at the Lot 1 basement. So you can see that the radius is actually just less than 200 meter. However, cannibalization rate is minimal at about 10%. Both are actually capturing different traffic flows, and both stores are actually performing. So this example itself is showing that if there are more avenues that Old Chang Kee can venture into, even at the same mall or area where it already has presence in. So to increase their store count, we first look into the macro backdrop, and we found out that the macro trend is actually favorable for Old Chang Kee to expand its store count. With the current retail scene of more conversion of retail shops into F&B outlets due to the slowdown of retail sales, and there's a recent suburban mall makeover trends, this actually offers opportunity for Old Chang Kee to expand both its store count as well as store space. So just to give you an idea of Old Chang Kee retail outlets, that more than 50% of its outlets are actually based in shopping malls. So with the recent suburban mall refurbishment, it actually could draw more footfalls post-renovation, and hence translate to a higher sales. So there are examples of the recent newly renovated outlets. For example, in the Compass One, Tiong Bahru, as well as Vivo City. So management have seen a better footfall for all these three outlets. So it should be reflected in the September sales, meaning their the quarter FY 17's results. So it also presents opportunities for Old Chang Kee to move into a bigger store space. So they are thinking of expanding store space to accommodate a sitting area for dining customers, or to convert into a 2-in-1 concept stores. So for sitting areas, you can they draw example of their Sun Plaza outlet, where they now have a dining area right beside their counter. So with more shopping malls undergoing a refurbishment, this actually offers them a chance to bid for higher space. So this sitting area is also one of their strategy to capture more consumers on for their ready food. As for their 2-in-1 concept store, it's actually combining an Old Chang Kee store with one of its sub-brands. So currently they are combining Old Chang Kee with Curry Times. You can actually take a look at one of their 2-in-1 concept stores in Kallang Stadium, where they have Old Chang Kee kiosk at the storefront right in front of the entrance. So this is actually this 2-in-1 concept actually improves its efficiency, because it optimizes manpower and resources. Referring to their store space as well as kitchen area. How is this possible? Is because that Old Chang Kee and Curry Times actually have a different peak period. Being that Old Chang Kee peak hour is usually during the tea break and off-office hour, while Curry Times will be on the lunch time and dinner period. So having Old Chang Kee together with its sub-brands is actually enhancing Old Chang Kee's visibility, and it also opens up more avenues for Old Chang Kee to open new stores. So having said that, we are also, we expect that free cash flows to continue to grow, given that their operating cash flow to grow and a normalized capex post FY18. So we think that this should be able to sustain their dividend payout above 60%, and it could also potentially increase their dividend payout in FY9 starting from FY19, which could translate to a 5.6% dividend yield. Although that Old Chang Kee does not have any fixed dividend policy, but it has a track record of paying dividends every year since 2008, since their listing. You can see that it paid out 20% of their earnings in 2008, and it increased up to 73% of dividend payout. 73% would be excluding their special dividend. It will be excluding this part. And we are expecting that they should be able to increase their dividend payout in starting from 2019, as it has a net cap position of 11.1 million as of last year's FY16, and it currently has about 6 million outstanding capex, and it should be funded via bank loan. With its healthy balance sheet, their healthy financials, we think that after its completion of its new integrated factory in first quarter of FY18, there should not be any big ticket item, and hence it should be able to increase their dividend payout. Last but not least, yes, Old Chang Kee, their core products is a curry puff, and we know that the major concern will be on a low barrier to entry. So how Old Chang Kee stands out among its competitors? So we think that these are the few economic modes that Old Chang Kee enjoys that that its competitors will have difficulties in replicating. First of all, would be their strong brand name recognition, which also allows Old Chang Kee to charge a premium for its products. So these are the few accolades that Old Chang Kee have, and they are testament to Old Chang Kee's being an all-time favorites to Singaporeans, and a testament to their good and consistent quality of food. Secondly, their economies of scale and technical skills. Having a big central kitchen to process raw materials and produces a range of paste, powder, pastry dough, and filling, as well as packaged food, are difficult to replicate by small players. Thirdly, on their pervasive market penetration through their network of 77 conveniently located retail outlets. And last but not least, a diversified customer base. So being halal certified, they actually will be able to capture a larger customer base, and having a long track record of halal certification actually helps to pave their way to expand into a Muslim dominant markets such as Indonesia and Malaysia. So these are the few assumptions that we have made. So we expect that same-store sales growth should be able to sustain at about 2.5% for the first 2 years. So once the new integrated factory has completed in first quarter of FY18, we expect that it will take probably 1 to 2 months before it take off and being fully integrated. So the effects should be able to be most prominent in from FY19 onwards. So from FY19 onwards, we're expecting a same-store sales growth to grow by 3%. And we are also assuming that one net store opening for each year from FY18 onwards. Net store meaning that we take into account of store closures due to lease termination or lease lease expiration, or any store closure due to shopping mall revamps and so. Next, we are also expecting that our margin should improve with productivity and operating efficiency, as well as a change of product mix via introduction of more high-value products. So you can see that our gross margin should continue to improve, and its net margin should be able to return back to a higher 7-ish percent as compared to its 2014 and FY15 period. We're also expecting that the operating expenses to normalize to about 54% of revenue because of easier property as well as labor markets. So these improved margins should be able to lift FY19 earnings growth back to near FY14's double-digit level. So we're expecting at about 20% growth in FY19. We're also assuming that Old Chang Kee would be able to maintain its negative cash conversion cycle and an increasing cash flow profile, as mentioned earlier, and that think that Old Chang Kee should be able to increase its dividend from 3 cents to 4 cents starting from FY19, which could translate to a 5.6% yield. So we use the DCF valuation, and given that we are using a base case scenario where we are only taking into account that starting from FY19, there should be a 3% growth in same-store sales. This would lead to a 98 cents, while in a bull case scenario where we will be able to see the results will kick in FY18, and a further improvement from FY19 onwards. This should be able to give us a $1.05 target price. If we are at a bear case scenario where it's going to stagnate at 2.5% same-store sales growth, this should give us 96 cents. So nonetheless, if we are looking at the most bearish scenario where we are assuming only a 0.5% growth terminal growth rate, we should be able to obtain a valuation of 78 cents. So 98 cents as compared to the last done price at 72. Last done price as of last Friday is actually offering a 42% upside, including dividend yield. So all this assumption is based on new production facilities, which could increase the capacity as well as introduce more new product offerings. We are also assuming that there's a growing store count and a higher dividend payout after FY18. Yeah. So we arrive at a 98 cents valuation. So to give you a sense of how it fared in the past 5 years, although that you might be seeing that is trading within its one standard deviation of its 5-year average and closer to the upper range, but nonetheless, you can see that there's a high jump here where the market actually re-rated Old Chang Kee based on the based on its when it started when it started to commence its construction projects for its 2 new factory in Iskandar as well as for Woodlands Terrace. So if you take into account of the re-rating, the average is actually about here. So it's not considered as expensive if you take into the re-rating catalyst. And we think that realization of the manufacturing productivity and efficiency would be able to lead to a further re-rating catalyst for the stock. And if you compare it against the 2 indices, STI as well as Catalyst, you can see that actually Old Chang Kee has outperformed these 2 indices in the past 1 year. Here, we took a peer comparison of Singapore's packaged food companies. So for ABR, it actually manages Swensen. It also has manages Tip Top Curry Puff as well. So we also took into consideration of other breads and pastry manufacturing or retailers. So with all these packaged food companies, we can see that although the Old Chang Kee is relatively smaller, but it has higher than peers margin, higher than peers dividend yield. Do take note that 8.5 includes a 3 cents dividend, a special dividend last year. If excluding their special dividend, is actually at about 4.5% dividend yield. So it's relatively comparable, but considerably higher than the top 3. It's also at a high net cash position, and also is giving you higher than peers ROE. So Old Chang Kee currently trades at about 17 times trailing PE. It's actually at a 30% discount to its Singapore's packaged food peers at 24.8 times. So this slide actually summarizes what are the risks that you might want to consider that might affect our investment thesis assumptions. Firstly, intensifying competition. Secondly, rising operating expenses, particularly on rental and labor costs. Rental and labor costs actually constitutes to 54% of its sales. So if it's going to increase further, it might compress margins. And Old Chang Kee is also subjected to risk of foreign worker levy, as about 50% of its direct laborers are foreigners. Execution risk with respect to location or stores. Outsourcing risk. Old Chang Kee has 2 major suppliers and contract manufacturers. So they actually outsource the manufacturing of its seafood products to 2 of its major suppliers, one in Singapore and the other one in Thailand. Nonetheless, these seafood products, for example, fish balls, nuggets, are actually easily replaced by, or it can easily be sourced from market itself. So management say that outsourcing risk does not really pose any significant risk to them. Other risks such as change in consumer taste and preference, food scare, outbreak of food-related disease. For example, the bird flu, which increases eggs price, FX risk. Old Chang Kee does not have any hedging policy. About 20% of its purchases are actually denominated in Thai baht and ringgit. Change of tenant mix, revamp or closure of shopping malls, which its retail outlets are located at. So this would affect its foot flow or traffic flow to its retail outlets. So these slides conclude my presentation. I would like to recap that we have a buy rating on Old Chang Kee with a target price of 98 cents. So the main key takeaway would be the completion of their factory, which would give an additional product lines with better margins. We are also expecting that dividends payout should improve after FY19. So with that, I would like to pass on to my colleague who will provide you an update on China Aviation Oil.
Hi, it's Guanzi here. Now we'll look at the China Aviation Oil CAO's third quarter and 9 months results. So we will maintain our core buy with the unchanged target price of $1.92, and the last close price was $1.40. Now let's take a look at the results. The top line, the revenue went up by 20.3% to 8.4 billion US dollars. This was due to the increase in total trading volume of jet fuel and other oil products, which offset the negative impact of decrease in jet fuel price. As you can see here, 9 months year to date, the total trading volume was reported at 24.3 million tons, compared with last year's 14.5 million tons. So another thing we need to highlight was that the share profits from associates and joint ventures it substantially went up by 62.9% to 53 million US dollars. This is still to the higher profit contributions from Shanghai Pudong International Airport. For 9 months, it contributed 47 million US dollars, compared with last year's 30.8 million US dollars. And the oil hub in Korea also contributed around 4 million US dollars. Sorry, this is typo. In 9 months here, with compared with the net loss during the same period of last year. So here we'll, as a result, the net profit went up by 42.4% to 71 million dollars, which in line with the substantial growth in the top line and share profits. So let's look at the revenue breakdown here. The revenue from middle distillates actually dropped slightly by 1.8% to 5.5 billion US dollars. This was due to the lower jet fuel price because the crude oil plunged over the past 9 months. For the revenue from other oil products, it went up by triple digits to 110% to 2.9 billion. As you can see here, the total trading volume grew by 72.7% 67.2% year to date. So as for the trading volume in jet fuel supply, it went up by around 19% to 11 million tons. For the trading volume in other oil products, it significantly went up by 128% to 12.4 million tons. So you can see here, because the sales management previously guided that they aim to grow the revenue from other oil products to 1/3 of the total revenue. But you can see here, over the 9 months data, it actually almost achieved this target. And for the net profit year to date, it is higher than it is even higher than last year's full year of 61.3 million US dollars. So as of September 16, the cash held on hand was reported at 232.8 million US dollars. So in the foreseeable future, we expect that CAO will continue its diversification strategy as well in the product mix, as well as the investment in association in oil-related assets. So next is the DBS Group results update.
Okay, morning. Okay, so for DBS, the net interest income has been rather flat. Year-on-year growth for loans has just up marginally at 1.8%. Most important thing I would like to emphasize is actually the vulnerability of net interest margins for DBS. As you can see, the average rates on interest earning assets fell by 11 basis points as compared to average rates on the interest bearing liabilities, which fell much lesser at 1 basis points. We alluded this to the existing high loans to deposits ratio for DBS, and what it really means is that at this 90% loans to deposit, DBS has less room to optimize net interest margins further by growing loan volumes faster than deposits. So in a low rates environment, DBS would seek to grow the loans volumes to offset the fall in rates in the interest earning assets in order to maintain the interest income. But if the loans to deposit ratio is at a high, it's close to about 90% or slightly above, it has less room to grow loans without first taking care of the funding on the liability side. And if it tries to grow the deposits in tandem, it has to increase the rates on the deposits, but that would be running in counter to the low rates for the interest earning assets. And it also has less room for it to reduce the interest expense on the liability side aggressively. At least it affects the funding on the deposit side and pushes the loan to deposits rates, the loan to deposits ratio higher even as loans volumes remain unchanged. So the thing is that if you were to compare DBS loan to deposit ratio at about 89 to 90%, to OCBC and UOB. OCBC is about 85.5%. UOB is 86.2%. So the other two banks are lower than DBS. And if you were to compare it to European banks, for example, like the Deutsche Bank, Credit Suisse and Standard Chartered, these three banks are less than 80% loan to deposits ratio. So the next thing is we'd like to emphasize that how the asset quality is not really the main issue in our opinion. Instead, we would try to emphasize on how is the bank going to grow the income to offset the deteriorating assets, because in terms of and what is most important about the bank's business is that when the assets are deteriorating, it has to have enough funding to make new loans, good quality loans, new good quality loans. So in that sense, it is a question of how it's able to access to new markets and also its funding capacity. So these are the two things that I think the market hasn't been paying attention to. And they are rather paying attention a lot more to the deteriorating asset quality. So the other segment of the DBS business, which is the non-interest income, especially the fee and commission income, and this helps support the total income, and it helps also to help them cover for the allowance expense on the income statement, and that would be from the wealth management, which is up 47% year on year, from higher bancassurance contributions, investment banking, which is up 74% year on year, higher equity markets, fixed income fees, and increased advisory activities. And cards is also an upcoming business unit for them, which is up 15% year on year. And the boost from ANZ acquisition is very timely because it allows them to access to $11 billion worth of customer loans, as well as $17 billion worth of customer deposits. So this helps to grow the volumes for the net interest income. And besides that, of course, we have the opportunity for them to grow the cards and wealth management franchise across this customer base. And next is iFAST. So iFAST has reported strong growth in total net revenue, supported by a much stronger recurring net revenue. And basically, what is happening now is that they are gaining traction from their current strategies, and this would be the Singapore business is actually now going to launch the stockbroking business by end of 2016 to early 2017. So this would actually increase their offerings to basically to the market. And the Hong Kong business has launched its stockbroking capabilities for the B2B, and this strategy is actually still targeted to the B2B segment and not so much for the B2C. So they still firmly believe in growing the business through their partners. And the Malaysian business has also introduced the insurance products distribution, and this will be for the B2C in the quarter. And the Chinese business, although it is still loss-making, but the traction is there. So what is most significant is that they have signed up 35 fund houses with over 1,400 funds on the platform. A strong improvement from 2Q's 20 fund houses and 1,000 funds. And we will be monitoring very closely on the RMB initiatives. With this, there could be a near-term catalyst where there will be more where they could engage cross-border activities from with corporates and equity investment funds from Chongqing, Suzhou, and Tianjin. And that comes to the end of my presentation. And next will be SIA Engineering. Thank you.
Hi, morning. This is Richard speaking. Okay, so now for SIA Engineering Company, which announced their results last week. So we've maintained our reduced rating with a new lower target price of 328. Previously was 339. We've also lowered our dividend forecast from 14 cents to 13.5 cents. That would be a yield of 3.7% if you base on last close of 364 from last Friday. So let's look at the results at a glance. So you can see Revenue was flat, just 0.5% lower. This was due to the lower fleet management mitigated by higher line maintenance. EBIT took quite a drop of 9.3%. This was due to mainly due to the higher material costs and higher staff costs, offset by lower subcontract costs. Associates and JVs was also 8% lower. Their contribution from engine repair and overhaul centers was 18.8% lower. So engine repair and overhaul centers are SIA and Eagle Services. So reported PATMI down 20%, but take note that a year ago, 2Q16, there was a 2.8 million gain from their disposal of the associate, and a final dividend of 1.5 million from Hazel, which will not happen again after the divestment. So if you adjust out these two one-off and non-recurring items, then the PATMI would actually be down by 11.7%. Okay, I'll talk about this bullet point first about the lower interim dividend. So dividend declared was 4 cents. This is lower than the previous year's interim dividend of 6 cents. So because of that, we have also lowered our full year forecast only by 0.5% as we have maintained our payout ratio assumption of 89%. Okay, some things that happened during the quarter. So in view of the challenging operating landscape for SIEC, they are doing some restructuring and they have partnered with the OEMs as well. So one thing within their own group, they have amalgamated their Rolls-Royce JVs. This is SIA and IECO. So this is these two JVs are dealing with the Rolls-Royce engines. The other one is they have gotten approval for heavy maintenance joint venture with Airbus. It's called Heavy Maintenance Singapore Services, or HMS Services for short. And then they are also integrating their two Pratt & Whitney JVs, which is CAS and IATA. So actually, if you recall, also in the past year, they have created another JV called BAPAS as well. And one thing that you have to think about is all this formulation of the JVs is in a way they are losing market share to the OEM, so they are losing bargaining power, and that's why they're forming the JVs with the OEM so that they can still try to maintain their market share. Last bullet point here about divestment gains. So they actually made substantial divestment gains this year, amounting to about 178 million. So there was no special dividend declared in 2Q. Management explained that they do not declare special dividends in 2Q and will only wait until 4Q to decide if they will be declaring special dividend. But they have said that they intend to use the proceeds of the divestment gains to reinvest in technology and build up capabilities. So it's unlikely that they will pay out the full amount in special dividend. We think that maybe up to half will be paid out and probably will not be paid out in one lump sum, maybe spread across at least 2 years. This slide is just for information. It shows a portfolio of the joint ventures. So right here at this bottom left corner here, this is the new one which they have created, Heavy Maintenance Singapore Services. The other one which I mentioned earlier, this one is the joint venture with Boeing for fleet management, BAPAS. Here is the one which they have combined, SESO and AICO, and the surviving entity is SESO. And here is the other two Pratt& and Whitney ones, CAS and IAT Asia, which will be integrated, and the surviving entity will be CAS. Okay, we have come to the end of this week's presentation. Again, this is the address for the archived webinars, so you can go to this address here to watch the webinars again and to access the PowerPoint slides in PDF format. If you have the old PDF, you can click on this link and it will redirect you directly to the archive. So now we'll pause for questions and answer.
Hi, there's a question on what is the Old Chang Kee's geographical profit distribution. So yes, I understand that Old Chang Kee has have retail outlets or businesses in Malaysia, in Indonesia, as well as Australia. But for their profit distribution wise, would be 100% from Singapore. So their overseas retail outlets are actually still lagging behind. And just to take note that their Indonesia business are actually on a franchise model. Nonetheless, they are currently looking at how to expand their Malaysia business. So they are looking for more B2B distribution partners.
Okay, we have a question about the ANZ improvement to DBS profit in the short term. So the projections for the official projections is for earnings is $200 million within 3 years with ROE more than 15%. But of course, this is the projection they have today. I think there are other knock-on effects, positive effects that could happen, which is basically the cards business, the wealth management business, and the impact on the non-interest income side. So if that franchise could enlarge, I think that earnings could improve better than what is declared on the forecast. Thanks.
There's a question that if air traffic is expected to grow strongly, how is SIEC will capitalize on this? So the thing is, number one, with each landing, that would benefit the line maintenance business for SIEC. When fleet size grows, then the fleet management program, that's the FMP business, will benefit from larger fleet sizes within the region, and utilization rate would step up the requirement for heavy maintenance as well as engine overhaul. But the thing is that there's been a structural change for the hardware. So the engines and the aircraft, their reliability have improved. So they are not requiring as much maintenance as before. Currently, you can see from their results, volume is low. Even when volume is expected to pick up next year, late part of next year, but even when that happens, work content will be much lower than previously. So do not expect a big jump in earnings for SIEC even when the volumes come in. All right, as there are no more questions, we'll end the webinar today. Thank you for tuning in. See you again next week.